Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the value of publicly held companies in the mortgage industry, my interview with Absolute Home Mortgage Corporation's Matthew VanFossen on how executives handle recruiters constantly attempting to poach top originators, and tariffs grab headlines, but fundamentals matter. Thanks to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights. Ocrolus is empowering underwriters to make timely, confident lending decisions. Whether you need to verify income across complex pay scenarios or review borrower documents with confidence, Ocrolus helps mortgage teams move at the speed of automation with the precision of human oversight. Learn more at ocrolus.com/mortgage. In news for fans of the wholesale lending channel heading into the baseball All-Star break, the Philadelphia Phillies, owned in part by Freedom Mortgage's Stan Middleman, are only half a game back in the East. UWM Holdings Corp CEO Matt Ishbia and SFS Holding Corp sold a combined total of 1.2 million shares of UWM Class A common stock in 3 separate transactions, netting approximately $5 million. The sales come as UWM, currently valued at $6.6 billion, has seen its stock decline by over 26% in the past 6 months. That said, UWM has invested $100 million in Built, which offers rewards for housing payments. Built originally made its name by offering renters the opportunity to earn points on rental payments and is building capital. The company announced that it has raised $250 million in new funding, bringing its total valuation to $10.75 billion. More than twice its valuation from roughly a year ago. It's also introducing Built Card 2.0, an upgraded credit card offering that will launch in February of next year. That's UWM. What's your company doing to obtain leads? Switching gears slightly, this past week brought renewed attention to trade policy as the July 9th expiration, and subsequent extension to next month, of the 90-day tariff pause reignited uncertainty in markets. While economic data was relatively light, key indicators showed real consumer spending declining by 0.3% in May, and credit growth slowing to a modest 1.2% annualized pace, both signs of softening momentum. Businesses are increasingly citing cost pressures from tariffs as a reason to raise prices, reinforcing expectations for rising inflation in the second half of the year. However, inflation pass-through remains limited, and consumer expectations for future inflation are falling. This divergence presents the Fed with a nuanced policy challenge. With inflation subdued and labor market conditions only gradually weakening, how many rate cuts are truly warranted by year-end? President Trump's aggressive trade stance escalated last week with fresh threats of a 35% tariff on select Canadian goods and a potential global doubling of blanket tariffs to 20%. These announcements, which came shortly after reinitiating talks with Canada, have further unnerved global markets, even as the Treasury market response remains relatively muted. Investors appear increasingly desensitized to trade war headlines, potentially due to the lack of immediate economic fallout or belief that the worst-case scenarios are unlikely. However, a wait-and-see sentiment prevails. Recent Treasury auctions have shown strong demand and stable pricing, but the potential for future volatility remains, particularly if August's tariff hikes start to pressure supply chains and consumer costs more visibly. For now, the labor market's resilience is holding up, but it's becoming harder for displaced workers to find new jobs. For today's interview, I want to welcome back to the show Absolute Home Mortgage Corporation's Matthew VanFossen to talk about how executives handle recruiters constantly attempting to poach top originators. He's president and CEO of Absolute Home Mortgage Corporation, and also an occasional host of one of our Tuesday shows, Mortgage Law Today, which covers regulation and compliance matters.
Unscrupulous recruiting practices. You're no stranger to this, which is why I wanted to have you on. You've both been someone on the sales side of things, and you've run a company and had to deal with recruiting, had to deal with losing people, those sorts of things. Maybe the best place to start would be for those people that might not have seen the video that Steve Majerus put out, talking about what transpired in the world of unscrupulous mortgage banking recruiting practices this last week.
Yeah, thanks for having me on, Robbie. And, I'm not a subject matter expert on exactly what transpired. I was just sitting in the crowd watching like a lot of others. And I think I saw a video out of Steve, talking to his internal staff. It might have even been an internal video that leaked. And he was addressing rumors that were on the street and rumors that there might be liquidity issues at his company, that there may have been some issues with hedging, and that there were some unscrupulous recruiting practices that, once the recruiters in the industry catch wind that there might be trouble inside the company, then they start doing their job, and they tend to be relentless in the matter, and they get inside the loan officer's ear. And it's a shame because you have some really, really great long-standing companies out there. And I think Serge One is one of those staples in the industry that, they run a nice, clean business practice. And I even think Steve said it himself in the video that usually he pays no mind to some of these recruiters out there, but it got to the point where he felt he had to address it. And I think that's just an unfortunate place as an executive. I see myself in that regard. A lot of mortgage companies struggle and have trouble. The fact that mortgage companies have survived the past 3 years is a testament to how strong they are, especially as an IMB. And we do see a lot of M&A activity, and the scariest part about the M&A activity is losing your sales force. So I feel for Steve, and I think just it's unfortunate that he had to identify it, but I'm happy that he did.
Yeah, well, I'll try and play devil's advocate a little bit, or I'll bring a cynical angle to it, and that would be succinctly put that where there's smoke, there's fire. Although I'm happy to allow you to say that no, it's not the case. Maybe something happens where payroll malfunctions, or somebody gets a weird vibe from a meeting with management, and suddenly the recruiters run with this, and it's, the whole company's going up in flames and you need to jump ship. I guess the question I want to ask you is, when you hear these rumors, how much validity is there at the end of the day, even if maybe in the short term the person leading the company can deny a lot of what's going on out there?
Well, one, you have to have integrity, and if something is going on, I don't think anybody would go out and publicly say it's not. And you have to address these rumors head on. And I think he did a great job at that. But I also think that, the larger your entity is, the higher risk you have at this, because loan originators and some operations employees, they're not preview to the boardroom. They're not preview to the inner workings of the company. And that's the exact rumor mill that we're talking about is, maybe there's an internal malfunction of something. Maybe there's a conference call that goes out when we're talking about hedge coverage that we have to tighten up and not give pricing exceptions. And that's how a rumor starts. And I think there's that old saying, loose lips sink ships. And, that's the biggest concern, that, when you're operating several hundred loan originators, 100 or so processors and operations employees, they can catch wind of something that may not have any validity to it. And, they leak that data and it gets into the wrong hands, and, the waterfall of recruiting starts.
Yeah, I want to ask you, as someone who runs a company, you're on both sides of this. One, your good salespeople are probably constantly being poached or attempted to be poached out there. And on the other hand, you're always looking to attract top talent. And I'm sure this answer varies by CEO, but when it comes to the way you view scrupulous or moral practices in terms of recruiting people in or letting people go, giving them information that might be beneficial to themselves if there's a reason for them to leave, where do you come down since you can see both sides of it?
So it's interesting. I think if you're an executive like me with an NMLS ID, you get targeted and attacked yourself. And sometimes I talk to the people and just, drag them along and have a little bit of good fun with them, like the boiler room newspaper scene, if you remember it. I think it's fun. And other times they catch me on a bad day, and, I tell them, I don't appreciate it. It's, for me, it's frustrating because sometimes I actually give them tips. Like I'll say to them, I'll ask what company they're from, what team they're with. And I'll say, well, did you even look me up? Did you Google me? Before you called me and told me that you saw my production and I'm a perfect fit for your company, did you even have the courtesy and respect to look and see that you're talking to an executive of one of your competition? And I think that's the biggest problem, that there's the emperor has no clothes with these recruiters, Robbie, that they're just feeding off of data in call centers. They're blindly calling whoever they want. And you know what the results in that? You don't get any quality people. A loan originator that picks up the phone for a recruiter with no relationship whatsoever, accepts a cold call, they're probably in a desperate position themselves. Because the truth of the matter is, top producers can go anywhere they want. So I don't ask as much why they leave my company, because we very rarely lose people, but I do like to ask why people stay. And it's a conversation that I frequently have with my managers. Guys, why are you happy here? What's good? What's bad? What's active communication? What is going on in the recruiting world? And the conference calls are all the same. Matt, we get hit up 20 times a day, right? The broker companies are relentless, and they're pitching 1099 compensation and 100% commission comp plans, and that's really attractive, but I need more resources. I like being in control. I like being a banker. So and do you lose people? Yeah, you absolutely do. I've definitely lost some people over the past couple of months, and I actually think the age bracket is interesting, Robbie. We're losing people that we groomed in as their first loan officer position. The guys in their 20s, right? That never originated a loan. We got them a license, and they've been around for 2 or 3 years, and they get that call, and it's their first time being recruited, and it's like, wow, I might be somebody. This person wants me to work for them, and it's exciting. And what you can't do is you can't burn a relationship, right? You can't call that person up and blast them and be like, how could you be leave the company? We gave you everything. No, you got to keep a relationship with them. You got to keep the door open, and more than anything, you got to run a sound business with good resources, good tools, good culture. And you're bound to lose people. Sometimes people just need to change because they want to change. But if you leave the door open, then they can always come back, because the grass isn't always greener.
Well, let me ask the flip side of that, which is, if there's top talent out there and you'd like them to come work for Absolute, just how far do you feel like you can go with your own conscience intact and say, this is fair game versus maybe this is where I would feel like I'm crossing the line in terms of attracting top talent?
Well, I think it comes down to your morals, right? We as executives, we go to industry conferences, events, we have relationships with other executives. You should never be directly targeting an entity, especially if it's an entity that you're preview to information where you know that they might be having a little trouble and they're asking for help, and you go and intentionally target that. That's a reputational risk and an ethical issue that I would hope not many actually do in practice. For me, we don't really use these robo-dialers and have recruiters calling around. I just don't think I get quality loan officers from it. How I recruit is relationship. I meet people. I keep my eyes and ears to the street. I go to the networking events. I'm at the local real estate association events. I'm at the local MBA events. And, a lot of times people come up to me and they say they're unhappy. And I have a decision to make. Sometimes, Robbie, I call the owner of the other company and say, hey, you have an unhappy loan officer. If I have a good relationship, because I have that type of respect for my other relationships. And a lot of times they say, Matt, if you want him, you can have him. That happens more than if he's unhappy, he's not happy here. I don't want him. You can take him. Right. And other times, they just appreciate and they try to retain the person. So I think there's a lot of mutual respect. I think that there's this old saying, Robbie, that the generals can break bread and the soldiers can go to war, meaning that the top executives can sit and have conversations, and be respectful for one another while the loan officers compete in the street. And I think that's good practices.
What do you think it is that good originators demand these days? I'm not sure. I'm not privy to how much movement we've seen at the top of the market when it comes to good originators switching around recently. I believe signing bonuses have certainly died down from the heyday a couple of years ago. But what does a good originator demand? What do they look for in current times? How can companies best support them and retain their top sales staff?
Robbie, that completely comes down to the person and who it is. Some top producers are out there just looking for a check. I will go to the highest bidder. Whoever's giving the biggest sign-on bonus, and I think it's silly. I think that that's an uneducated stance. Why? Because the person cutting you the highest sign-on bonus is probably going to put the highest margin inside your pricing and not be transparent with you. If you were a smart originator, you'd be looking, and you were a top producer, you'd be looking at a company that you could hang your hat, not for the next 6 months to a year, but the next 5 to 10 years. And there's a lot of due diligence that you have to do there. You have to see if the company's financially sound. You have to go, I would talk to other top producers that have been there for 7 or 10 years and say, why did you stay? What's it like? Do you have accessibility to the decision makers in the company, or are you in a silo? How's the leadership? How's the tech stack, right? Are you going to be moving from one LOS to another LOS? And that's going to cause your operation and processing team to have this learning cycle. So it's not always about the money, but it's a lot about the culture, the systems, and your ability to grow. And I really think that the most important question that an originator can ask a company that they're thinking about going to is, what are you going to do to help me grow? What are you going to do? I want a plan. I want to know, if I come into the CEO's office, what does this company do that gives me the tools and resources to grow my business, whether it's 10%, 15, 20, or 100%, whatever they want. I think that's a big question.
Well, I'm going to go utopian before I let you go, since you answered that previous question that way. We saw the trigger leads bill finally get passed here, so there's some progress there. It took a lot of effort. That's the word. It took a lot of effort and people speaking up to finally get it somewhere. When it comes to these recruiting practices, do you see any change on the horizon? And if so, what would it take to get there?
Well, no, I don't think it's really tied into trigger leads.
I'm saying something that frustrates a lot of people in the industry, that sort of.
People are fed up, right? I have loan officers asking if we can file claims against other companies for TCPA violations. It's business to business. There's nothing you can do about it. You can just ask them, put it in writing, respectfully ask them to stop, recruiting and stop reaching out. And that's really all you can do. But I do know that originators are frustrated. They're fed up with the phone calls. They're fed up with the empty conversations that there's not much merit to. It's just noise and distractions. And I think the worst part is, as a salesperson, Robbie, you have to pick up your phone. When a random number calls you, you have no choice. You have to pick up the phone because it could be a realtor, it could be a client. And that's how they get you on the phone. So be nice to them, be courteous. If they're aggressive, feel free to be aggressive back and just tell them to stop calling you or recruit them.
Very well put. Always a pleasure speaking with you. So thank you very much, Mr. VanFossen.
Anytime.
This week offers a packed schedule across markets, with attention shifting from President Trump's latest tariff threats, now targeting the EU and Mexico, to the kickoff of the second quarter earnings season. Major U.S. banks like JP Morgan, Bank of America, Citigroup, Wells Fargo, Morgan Stanley, and Goldman Sachs are set to report alongside corporate heavyweights. The economic calendar is equally robust, with key inflation data in the form of June's Consumer Price Index on Tuesday, Producer Price Index and industrial production figures on Wednesday, followed by retail sales and import prices on Thursday and preliminary July consumer sentiment on Friday. Fed speakers will also be active throughout the week, potentially shaping expectations for future policy moves. MBS Class B and C 48-hour notifications are scheduled for Tuesday and Thursday, respectively. The week starts off slowly with some short-duration Treasury auctions, and without anything of note on today's economic calendar, we begin the week with agency MBS prices unchanged from Friday, the 2-year yielding 3.89, and the 10-year yielding 4.43 after closing last week at 4.42%. Let's wrap up with a joke and some housekeeping. Be careful when you follow the masses. Sometimes the M is silent. Thanks again to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights that empower underwriters to make timely, confident lending decisions. To learn more, visit ocrolus.com.